Hello everyone, thank you for joining us and a very warm welcome to you all for our webinar, Betashares Managed Accounts. Before we start, I'll just touch on a few things. This webinar is for financial advisors only and the materials are should not be distributed to retail investors. A copy of the slides will be available to you and sent email to you later today. And if you have any questions, please put them in the dialogue box there. We have a record number of advisors that have dialed in for this. We will attempt to get through a few questions, the key questions, but if not, we will follow up with you after this to answer your questions, but please put them in the dialogue box. My name is Vinnie Wadhera. I'm an Executive Director at Betashares, and I've recently been promoted to the role of heading up our model portfolio business, Business Solutions. I'll introduce you to two of my colleagues, Isaak Walkom. Isaak Walkom is a director in the Portfolio Solutions team. He's been with Betashares for over 6 years. Also joined on the line there in another room is David Bassanese. David is our Chief Economist, and he's also the chairperson for the Betashares Investment Committee that's responsible for our diversified ETFs and our managed account solutions. Today, I'm going to provide a very quick update on Betashares, particularly in relation to managed accounts. We'll then focus on the second area in terms of the benefits of managed accounts and some of the key features of the Betashares managed accounts, particularly in relation to our two flagship series, the Dynamic series and the Ethical series. I'll hand over to Dave to give some of his market views and the asset allocation views that we express in these managed account portfolios. And then I'll also cover off to finish off in terms of the service and support that we offer for our managed accounts. So let's kick off. In terms of a very quick Betashares update, look, and many of you have known us and have known us for a long time, but I thought it'd be relevant just to give a quick update. As you know, we have over 80 ETFs now on the ASX. We've also recently launched some New Zealand domicile funds. So we've set up 5 funds based on our flagship strategies in New Zealand. We actually have exceeded 30 billion in terms of assets and over 130 staff. In terms of managed accounts, we have been running managed accounts, diversified portfolios for coming up to 8 years now, and there is now close to 2 billion in terms of assets in our multi-asset strategies across diversified ETFs and managed accounts. A recent statistics that was released by Rainmaker actually combine the assets under management and net flows across fund managers that have both ETFs and managed funds, and on a recent trailing 12-month basis, Betashares actually ranks #1 in terms of net inflows over that period. Look, we put this down to a few things. It's a testament to our products and solutions, which many of you have reviewed, researched, and included in client portfolios. So we thank you for your efforts there. It's a testament to our service and support offering, and it's the same service and support that we have applied to our managed accounts also. And it's also a testament to the values that we instill in our staff and we hold ourselves accountable to. In terms of managed accounts, look, managed accounts really have become the preferred implementation solution for advisors. Just yesterday, Rainmaker published their latest industry statistics, and managed accounts, there is now in excess of 160 billion in assets, and that's up 19% according to Rainmaker. And a bulk of that, a large percentage of that, almost 100 billion of that 162 billion is in the category of separately managed account, SMAs. And the Institute of Managed Account Providers, IMAP, also produce similar statistics, and their half-yearly report, which is due out shortly, will show a similar pickup and trajectory over the years. And look, the reasons for the adoption of SMAs is listed out here. The big one is operational efficiency. So really freeing up time in terms of portfolio management and everything that encompasses that. Manager research, selection, overall implementation is actually outsourced to a managed account model manager, or if you're running it in-house, there's a dedicated team doing that. It strengthens the value proposition, allows advisors to focus on the real value add components of advice, and your advice service fee is commensurate with that. The cost effectiveness comes in a number of ways, and it's particularly effective when the managed account is utilising low cost ETFs. You know, those cost savings can compound over years and can be a real difference in terms of total portfolio returns. And the last one is transparency. So, you know, your clients can see the underlying holdings, and with ETF managed accounts, they can actually see the underlying holdings of those funds. And of course, with an SMA, your clients are a beneficial owner of those underlying funds. Now, we could do a whole webinar on its own in terms of the benefits and efficiencies and value add of managed accounts. Many platform providers actually produce some very good material on this, and certainly we can follow up with you with your particular platform BDM to run through more details on managed accounts, and particularly SMAs. But this schematic here really does summarize it. The previous historical process would be, you know, the advisor going through a fact find, an ROA process, and doing all of the research, but it's that implementation piece that takes up a lot of time. Client by client implementation, doing the ongoing, the transaction costs involved with that, and then any changes that are done require a record of advice. So a very administratively burdened process. So essentially that part of it, that implementation, the portfolio management part, really is where the efficiencies lie. In using a managed account, that is all done by the model manager and the platform. Rebalancing, trading, and any changes that are made don't require an ongoing ROA. Again, there's a whole lot of other benefits, and we can circle back. The platforms have some very good information on their websites, but we can follow up with you on the benefits and efficiencies of managed accounts. Let's now turn to Betashares and the Betashares philosophy here. So firstly, as I mentioned, Betashares has been running managed accounts for over 8 years. Our managed accounts really are a packaging up of a lot of the existing IP, knowledge, and skill set within the Betashares business. And that includes our Chief Economist, our investment strategist team, our portfolio management team. It also includes our unique and differentiated investment product suite. And then it's all encompassed by very comprehensive reporting and service and support. But our philosophy here, we've listed here, it's utilising passive exposures for the asset class. So what we're not doing is doing stock selection or using active managers, and Isaak will touch on some of the technical features in a moment. We're using smart beta to add some value, and we're also using undertaking dynamic asset allocation. Now, low cost, we talk about low cost, and Isaak will talk about some of the value add that comes with that we've embedded. Low cost doesn't mean that it's just a set and forget portfolio, but let's just look at the low cost aspect here. And again, these are indicative fees. Again, we can follow up with you, or you can double check with your platform PDSs on what the fee load is. But on an indicative basis, this is the fee and the fee split. So the underlying fund costs, well, that is the same and precise across all platforms. That is the aggregate underlying management fee of the funds we're holding. And for a balanced profile, it's 17 basis points. There's an additional 19 basis points for portfolio management. So that takes the all-in investment fee to around about 36 basis points. And then again, we've made an indicative estimate of platform administration at 30 basis points. So you can see the all-in fee before your advice service fee can come in sub 70 basis points, which is quite low cost. And again, we'll talk about the value add benefits in a moment. But having said that, there are also now some lower cost core type platforms. And for those, the portfolio management fee is a little bit lower and the platform administration fee is a little bit lower. So please get in touch with us, and we're happy to share more details on those with you. Before I hand over to Isaak, I just wanted to talk about just the various applications of the Betashares managed accounts, particularly of their low cost nature. First one is total outsourcing. So some advice groups have completely outsourced portfolio management, and it allows them to instead focus on some high value aspects of advice. And their advice service fee is commensurate with that. A second application is segmenting clients, usually based on a dollar value, but it can be done in other areas also in terms of accumulators and deaccumulators. But if it's done on a dollar value basis, some advice groups have actually segmented those clients, and the solution for them is a low cost managed account portfolio. They will still retain doing customized bespoke portfolios for higher dollar value clients. The third one is a core satellite approach, and this is a very popular adoption of managed accounts, particularly low cost managed accounts like Betashares. And it's particularly important because the Betashares managed account is used as the core part of the portfolio. That's the low cost, predictable part of the portfolio, the part of the portfolio that's going to ultimately deliver on the investor profile objectives of the client. What that then allows you to do is to focus and to implement client preferences for the satellite part of the portfolio, whether that be high conviction active managers or thematic exposures using ETFs. And the last one is a superannuation solution, both as a complement or replacement for industry super funds and multi-manager retail funds. Obviously, the benefit versus an ETF, an industry super fund is, well, firstly, the fee load is comparable, but what your clients are receiving here is beneficial ownership of a real portfolio where they own the underlying funds. And against a multi-manager fund, obviously, it may come in at a lower cost, particularly because the utilization of high-cost active managers. But I'll pause there and I'll hand over to Isaak to run through some more details on the managed accounts themselves.
Thanks, Vinnie, and thanks everyone for their time today. As Vinnie sort of highlighted at the outset, Betashares have been running managed accounts, or our dynamic managed accounts, since December 2015 now, so coming up on 8 years track record. And within the managed accounts, we have five different risk profiles, so conservative through to high growth. Conservative strategic growth allocation is 20% growth assets, moderate is 35%, balance is 50%, growth is 70%, and then high growth is 90%. In terms of the process for developing these managed accounts, first of all, there's the asset class forecast. So asset class return, long run return assumptions. Part 2 is the risk assessment, so correlations and standard deviations. Part 3, which is the portfolio optimization, attempts to achieve the maximum expected return subject to risk constraints. And the risk constraints that we use are the APRA standard risk measures, which stipulate a certain number of negative years, or no more than 3 negative years for the balance profile over a 20-year period. So that's how we arrive at a balanced portfolio of 50-50. Part 4 and 5 there refer to the dynamic tilts that we're making within these portfolios, or the investment committee is making. And some of the inputs there include historical valuations, rolling 1 year projected returns, but also there's a qualitative overlay as well. So trends in markets at the moment, and also expected future trends. Part 6 is obviously the ETF selection, which I'll go into in more detail in a second. And then part 7, which is ongoing review and monitoring of the portfolios. One of the key features of our dynamic series is that the investment committee are all Australian based. So they're accessible to you to answer any questions or client queries. They're accessible for client events. There's also the added benefit where our senior portfolio management team is part of our committee. So on a daily basis, they're managing ETF portfolios, both fixed income, equity asset classes, but also multi-asset portfolios. So they're familiar with liquidity, market impact costs of trading ETFs, and all the things that you'd like to see within an investment committee for managed accounts. Obviously, they're all very experienced, and there's 5 voting members on our committee. The second part here is best of breed ETF selection. So all underlying ETFs are selected on merit. The output of this is at present there's 7 Betashares ETFs and 4 Vanguard ETFs. When we say selected on merit, there's a lot of inputs into this process, things like fees, intra-asset class attributes, bid-offer spreads, liquidity, tracking error, and also reputation of the ETF provider. So there's a number of different factors that go into selecting the ETFs used in these portfolios. The third feature here is we do dynamic asset allocation. So our belief is that from time to time, there are asset class mispricings. So there is the potential to capture alpha within dynamic asset allocation. The second reason we do dynamic asset allocation is also, though, to manage downside risk. Our models are not as granular as some other providers, so we focus on the big decisions. The main big decision is obviously your growth versus defensive asset allocation split. Within growth assets, then, we look at Australian versus international equities, Australian property versus Australian equities. And then within the defensive bucket, we look at bonds versus cash, international bonds versus Australian bonds. And then we, from time to time, also use gold as an alts exposure, which, for example, was used during COVID. We also, we don't get into overweighting or underweighting specific countries either. So it's just the big framework asset allocation decisions. The fourth key feature is the mix of smart beta and market cap. Historical data shows that it is extremely difficult for active managers to consistently outperform their benchmarks. So here is the SPIVA report to the end of December 2022. So on a 10-year basis, broad Australian equities, 78% of managers underperform the benchmark. For broad-based international equities, you can see that 95% underperform the benchmark. There are certainly good active managers out there, but they're equally as hard to find. So what we do is we mix smart beta and market cap. So smart beta overcomes some of the limitations of market cap, and it also you're able to more accurately target or sources of risk, return premium. So QOZ, for instance, is a research affiliate's fundamentally weighted index. So it breaks the link with price and is away from market cap. That's what we use within Australian equities. QUS is a S&P 500 equal weighted ETF. So it goes away from some of the concentration at the top of the US market. So all the stocks within that ETF are held with a weighting of 0.2%. QLTY, or our quality ETF, so that's a quality factor exposure. And then OZBD is an Australian fixed income exposure, which is a Bloomberg enhanced yield index that fund tracks. So all the smart beta exposures that we're using have demonstrated over the long run that they can and do add alpha to the portfolios. I'll hand over to Vinnie just to cover off our ethical suite.
Thanks, Isaac. I thought it relevant just to highlight some of our ESG credentials, particularly in light of our second series of managed accounts, which is the responsible or the ethical suite of SMAs. Look, Betashares has a pioneering and leadership role in ethical responsible investing in Australia. We manage, it's actually close to 5 billion, but well in excess of 4 billion in assets across funds, across ethical products. So this is our core exposures, and our flagship funds there, as many of you know, are EFI, FAIR, GBND. We also have more impactful products, ERTH, Earth, and then some sustainability themed products. We've got some awards and credentials there, but if I can just highlight and look across our suite, we have a very wide range of investors, where usually based on a review process, the Betashares ETFs have been selected on merit, and that's ranging from investors like institutional investors, not-for-profits, advice groups, and even other SMA model managers that have selected our responsible investing suite. Look, some of the key features of why we've selected is our very stringent screening process, our very transparent screening processes or investment process, and also essentially making it a true to label exposure. I won't go through the details. Again, we're very happy to run through this, but I just wanted to highlight that the reasons why our underlying ETFs are selected is because of this true to label transparent features. We also provide very comprehensive reporting on our ETFs, and again, that transpires up at the portfolio level for managed accounts also. And of course, along with all of the reporting comes our investment principles, which span across very comprehensive stewardship. So we will undertake proactive engagement with companies, and we will also publish all of our proxy voting. So we're very active with proxy voting too. And again, this is all very relevant. And sorry, I'll just highlight one more thing, is the tools and support we provide for ethical investing too. Here is a very client-friendly fact find that we've collated that allows you to sit down with a client to understand their preferences in terms of ethical investing. And then you can use this as part of your SOA and fact find to match with products and or portfolios. And again, that was all very relevant in terms of the context of now constructing, because we use those as building blocks for our managed account portfolios. Isaac?
So within our ethical managed accounts, we have the 4 portfolios. So that's a direct stock Australian Sustainability Leaders portfolio. So that's a portfolio of 35 or approximately 35 stocks, which is a subset of our well-supported FAIR ETF. We then have the multi-asset portfolios consisting of balanced growth and high growth with the same risk profiles as that of our dynamic portfolios for those 3 risk profiles. So these portfolios are made up of the direct stock Australian SMA. So that's the holding, the Australian equities holding and allocation within these multi-asset portfolios. The international holding is our FE ETF, again, very well supported. And the fixed income or bonds exposure is GBND within these portfolios. I haven't touched on performance for dynamic or ethical, but our performance stacks up well against benchmarks, against active peers, against passive peers. It's available on our website, but we'd be more than happy to take you through it or address any questions you had alongside your account manager. So let us know after this webinar. I'll now pass over to David, who will cover off asset allocation views and also how it affects or how we're showing those at the moment within our models.
Thanks, Isaac. Thanks, Vinnie. Great to be with you all today. Yeah, so I'll just give you a taste of the framework that we go through in thinking about the dynamic asset allocation aspects to the report. First and foremost, here's actually just by way of backdrop, as Isaac mentioned, I mean, one of the main asset allocation decisions is growth versus defensive assets, being overweight equities versus bonds. And our study of this over time is that, you really want to reserve those judgments of being underweight equities to periods where you think there's a heightened risk of a global recession, particularly a US recession. Because generally speaking, equities are going to beat bonds over time. Where they do most of the damage is during periods of recession. If there's any number of reasons where markets can have short-term corrections, but from a timing perspective, that's a very hard thing to get right. So we do, really focus on periods where we think there's a heightened risk of recession. And in that vein, I'll just start with the first chart there. Shows you the global composite PMI index for the global economy. It covers services and manufacturing, US, Europe, Japan, emerging markets. And the point there is that at the moment, it's comfortably in this 50 to 55 area, a sort of Goldilocks zone, the global economy not too hot, not too cold. It did weaken through the course of last year on the back of interest rate increases, and there was a fear of the global economy going into recession. Certainly the manufacturing sector in several countries was in recession itself late last year. But as you can see, it has bounced back, and really the broad theme that's emerged in recent months has been the global economy has been resilient to the interest rate increases that we've seen since the start of last year. So the fears of a global recession have not yet been realised, importantly. Now, just going to the next slide. Good news also in that the failure of the global economy to tumble into recession and to display resilience has not come at the cost of inflation staying uncomfortably high. You can see inflation in many of the major economies around the world has been falling, and in fact, if you look at the US, look at Europe, you could argue inflation has been falling as fast as it rose. Certainly, the headline inflation numbers there. Now, that's been helped by the decline in oil prices following post the initial surge when Russia invaded Ukraine, and the decline in food prices. But we're also seeing more broadly supply chain bottlenecks during COVID have been fixed up. Goods prices have been declining. We know that housing costs have been very important in the US, and they are now starting to decline as well. And there's a lingering area. If there is one lingering concern, well, there's always a few concerns, but in terms of the key concern at the moment has been the resilience of service sector inflation, the tightness of labour markets, and the high level of wages growth. But even on that front, there is some emerging good news, as we'll get to on the next slide. So this is just a chart of the job vacancy rate in the US and the US unemployment rate. And up until the last, up at the start of late 21, early 22, you had a situation where job vacancies were very high. There was a lot of excess demand for labour in the US. Wages growth was running at a very strong pace. And historically, as you can see, if you go back to 07, 08 during the GFC and 2000, 2001, during the last two previous US recessions, COVID being an exception, you didn't get a decline in job vacancies without an increase in unemployment almost at the same time. So that's why there was a fear that, yes, to reduce the excess demand for labour, you probably need to push the economy into recession. But what we've seen is that job vacancies have been falling, and so far at least there's not been a material increase in the US unemployment rate. And why is that? Because a lot of the adjustment has come through an increase in labour supply. So labour force participation has picked up, rate of immigration into the US has picked up. So a lot of those excess, those job vacancies are being filled by a positive supply response rather than a negative demand response. And so that bodes well for inflation coming down even in the services sector. We're seeing wage inflation starting to come down in the US. And really, so to our mind, in fact, in our latest investment committee meeting a couple of weeks ago, we did move from an underweight position in growth assets due to the risk of the US going into recession back to a neutral position. So we're no longer underweight equities because we think that the encouraging developments in the labour market, the continued decline in inflation means that central banks, particularly the US Federal Reserve, won't need to keep raising rates and push the economy into recession. There's a very good chance that inflation will slow of its own accord without the economy needing to go into recession. So from, again, going back to what I said earlier, that suggests, at least being neutrally positioned within the equity market rather than being underweight. Go to the next slide. So broadly speaking, we think we're close to the end of the monetary tightening cycle globally. Markets have got like a 50-50 probability of one more rate rise in the US and even one more rate rise in Australia by year end. But broadly, I don't think there will be any further rate rises, and I think the next major move in interest rates will be down as inflation continues to come down as we head into 2024. And it's got a chart there of US 10-year bond yields. You can see they've recently ticked back up over 4%. And that's because basically what the markets have done is the resilience of the economy has meant that they were pricing in rate cuts in the first half of last year. They've now priced those out. They've pushed that out to the second half of last year. But again, broadly, provided you don't think there's further significant rate rises, I think, bond yields can still broadly sort of top out at these levels. I don't expect the sort of 12-month forward expectation for the cash rate to go much beyond where it currently is. So we're anticipating, so in fact, if anything, the sell-off in bond markets in the last few weeks, bond yields picking up above 4%, is actually maybe a last-ditch buying opportunity in this area. So we do see bonds as particularly good value at the moment. Going to the just in terms of the equity markets, look, a lot of information there, but I just want to focus on a couple of points. Firstly, the rebound in equity prices that we've seen since late last year has come at a time when you've had earnings downgrades through last year and to the first part of last year. So if you look at that on the top right side, their forward earnings have been going sideways. So there's been no real growth in earnings, but so the rebound in the markets has been driven by by valuations, and so the PE ratio for the global market has gone from under 15 to over 16. And if at the same time bond yields, they've stopped rising, they haven't really fallen in a major way. And so if you look at the bottom left corner, bottom right corner, you look at the equity risk premium, it is now narrowed down to about 2%, which is the lowest level since 2007. So certainly valuations are looking, certainly on an equity risk premium, looking tight or fully valued. But again, we think this is a little bit of the market getting ahead of the fundamentals, a bit like in COVID. In 2020, the markets bottomed quickly, rebounded in the hopes of a V-shaped recovery from COVID, and it just turned out we actually did get a V-shaped recovery. Markets have been rallying since late October on the hopes of a soft landing, on the hopes the global economy can avoid a recession. And in fact, the evidence over the last few months is actually moving in that direction. So although valuations do look stretched, if bond yields do start to fall over the course of the coming year and we do get a recovery in earnings, then maybe you get a short-run pullback in the markets, but we don't think we're going to revisit those bear market lows that we saw late last year. So we are, valuations do suggest some caution in the short run, but it's not enough to suggest, retaining an underweight to the equities at the moment. So just to conclude what all that means, this is a summary of our asset allocation as at the last investment committee meeting at the end of August. And you see, and again, in the framework that Isaak mentioned, we do focus on the big picture, a handful of key big picture decisions. Firstly, growth versus defensive assets. And we're back to a neutral position here. We're more open-minded that inflation can come down without a global recession. We do still like bonds. We think the next major move in bond yields is going to be down. And when bond yields are falling, typically bonds outperform cash. So within defensive assets, although we're neutrally positioned overall in defensive assets, within defensive assets, we're favouring bonds over cash. The other sort of tilts that we can do, Australian versus global equities, listed property versus Australian equities, we're retaining a neutral position at this point because there's arguments either way in terms of which will outperform. Declining bond yields tends to favour technology and growth sectors of markets, which favour global markets. But they have run pretty hard relative to the value parts of the market. Australia has been underperforming over the past year. So if the soft landing does emerge, there is scope for the value parts of the market, such as Australia, to outperform. So we're taking a sort of cautious approach on whether Australia is going to outperform or underperform as the global soft landing scenario plays out. That's pretty much it from me, and I'll hand back to my colleagues.
Thank you, David. We might, if you can stay on, and we might circle back with you on Q&A. There are a few questions that have come through for you. The last section, let me just please cover off our service and support, which we've put together. I'll just touch on, firstly, we have a Research House rating report available on the Betashares Managed Accounts. It's undertaken by SQM Research, and it is quite favourable. If you would like a copy of that, please contact your account manager, or please send an email to so it's info at betashares.com.au, and we will send that to you. In terms of the availability of Betashares Managed Accounts, an interesting piece of research or analysis conducted by Rainmaker is where they've tabulated up what they call the points of presence of managed accounts on the various platforms in Australia. And Betashares actually ranks #1, and that is #1 in terms of points of presence across for our managed account portfolios across the various platform menus. And speaking of that, and you'll get a copy of these slides, this is the suite of the Betashares Dynamic Managed Accounts, the suite of 5 portfolios across the various platforms. So you can see the number of platforms that our managed accounts are available on, and you'll see the platform codes also. And similarly, for our ethical managed accounts, we're on 4 platforms, and they're the 4 portfolios there too. We've got these codes and platforms in a summary flyer, which we will attach as part of the follow-up also. But importantly, I just wanted to share the very comprehensive service and support that we've put in place here. And it exists at a number of levels. The first level that it exists at is actually at the managed account or portfolio level. So we've put together everything you need as part of your advice delivery. So SOA templates, fact sheets. We've put together comprehensive reporting that you'll need on an ongoing basis. And that's both very client-friendly reporting in terms of client-friendly emails that you can use as a template or on forward, but also detailed reporting too, which you may require too, about our market views and what's happening in the portfolios. As a follow-up, we'll also send you our latest, which we're putting together the end of August 3-monthly information pack. So everyone that's registered to this webinar will make sure that you receive a copy. In terms of the client-friendly material, as I mentioned, it's not just the reporting, but also very client-friendly emails. Here's an example of one that's embedded as part of the periodic reporting. It's just David essentially in a very short 3-minute video sharing our house views in terms of markets and what our asset allocation positioning is. So that's on the reporting side. At the second level is the service and support that we provide at your advice practice level. We're very conscious if you're going to be using the Betashares managed accounts in any of those applications that I mentioned for, but particularly the core satellite or outsourcing applications, is we really want to support you and be a partner at a business level. So we have launched, and you'll see this on our website and a lot of the communications that we've sent, is the Business Acceleration Services. And this encompasses some services that we've offered over the years, but some genuine new ones at the practice management level too. The first one is portfolio analytics and construction. So we have an in-house analytics desk. This is particularly relevant for those advisors that use us as a core satellite approach. So using our managed accounts as a core part of the portfolio and implementing client preferences in the satellite. So we're able to assist in terms of doing the overall modeling and ongoing reporting of the portfolio. So again, please let us know if that's of interest. The capital markets insight. Now, David, you've just heard David in terms of our market views, but that doesn't just extend to David. It extends views from our portfolio management team, our investment strategy team, and ongoing reviews of our portfolios too. So all of them are available directly to you. So the investment professionals managing these portfolios are directly available to you and your clients. Responsible investing I covered before, particularly in terms of the reporting, the client-friendly tools, and our stewardship reporting. The last one I just wanted to touch on is the practice development and marketing support. We have applied a number of resources and cost and time to develop a suite of services to assist at your practice level. And this is the breadth of services that we offer. And again, this is reserved for particularly advisors that are using our managed accounts in a meaningful way. The first one is helping you collate a short form business plan. So we'll go through a workbook and a workshop to help you collate that, and members of your team can be involved in that. The second one is a client value proposition. So again, we'll go through a process of helping you collate that through a workbook and workshop process. Investment philosophy, articulating that and helping you document that. And that's not our investment philosophy, that's helping you collate yours. We've found that advisors that we've worked with on this will use that investment philosophy document as part of their SOA and even have it on their website. The last one, which I don't have a visual for, but we will happy to share a lot more details with you on a one-on-one meeting is our marketing consulting support. So it's being able to leverage off our own internal capabilities and resources to help you formulate a marketing plan. So again, please let us know if any of that is of interest. And then the last level of service is really a transition plan. So for those advisors that are looking to transition portfolios from where they might be to the Betashares managed accounts, we have a seamless process that we've implemented with a number of advice practices to make that actionable. So again, please let us know. But I'll pause there and just throw open to some questions now. And we've actually been, well, there's quite a lot of questions that have come through, but let's just take a few of them in the time that we have. The first question, David, I'll direct to you is, what is the risk of a soft landing materializing?
Yeah, so I guess the risks to it is if inflation remains stubbornly high, and the risk to the global economy is central banks. If central banks decide we need to push the economy into recession because it's the only way to get inflation down, we don't want to repeat the mistakes of the 70s, they'll do it. They've said they'll do it. So we want to see inflation continuing to fall. Now, some risks to that are, firstly, I mentioned the US labour market. Wages growth is coming down. It is still too high. It still needs to come down. Service sector inflation in the US is still too high also, but it is moving in the right direction. So that needs to continue to happen. Secondly, got to keep a watch on things like oil prices. They have bounced back over the last few weeks. Saudi Arabia overnight just announced an extension of its 1 million per barrel per day production cut. So if that keeps happening, headline inflation could rebound and could get central banks worried about, again, inflation expectations picking up, that getting embedded into wages. Just on that, I mean, I think, you know, push comes to shove, Saudi Arabia doesn't want to push the global economy into recession. It would lead to too much demand destruction. And so if you know, the global economy can't withstand those prices, there is a risk. I think they can, you know, increase supply again. So importantly, there is supply available in all markets. It's been artificially constrained at the moment, but if they do need to bring more supply into the market, they can. But they're the two key risks I'm focusing on at the moment.
Great, thank you, David. Isaak, I might throw to you for this one, but questions come through. What is the difference between Betashares ethical ETFs and the ethical managed accounts?
Cheers, Vinnie. So the key difference is the direct stocks within the managed account. So each investor directly owns the 35 or approximately 35 Australian equity stocks within the managed account portfolio. For the Australian equities component, there's then also the fixed income and international equities component of the managed account, which are also included in the ETFs. Yeah. The managed accounts also have additional reporting. So as Vinnie touched on before, we do extensive quarterly reporting. So although the ESG portfolios are strategic, they are still rebalanced quarterly, and there's a quarterly report sent to all investors. This reporting includes things like proxy voting and also client engagement. So it's really more tailored to around the true to label ethical nature of the managed account rather than making dynamic adjustments on a quarterly basis.
That's right. And I think a follow-up question there from the same advisor is just questioning the fee differential. So there is a fee differential between our ASX listed ethical ETFs versus the managed account ethical portfolios. And to summarize that, the differences are the direct stock portfolio and of course the very comprehensive reporting and service and support for the managed accounts. I mean, your clients are receiving a real portfolio where they're a beneficial owner of the underlying assets for a managed account. Another question is, are we able to white label your managed accounts? Look, the answer is yes, but just to be clear here, white labeling is where Betashares is still the appointed investment manager, and it is simply a white label of our managed account portfolios. Now, that will require a discussion with your platform. There will be some minimum investment amounts and flows, but certainly we can facilitate that. We do actually run some white label portfolios for certain advice groups presently. And another question, do I need to be listed products accredited to use managed accounts? So look, the answer to that is generally no, but please double check with your licensee what's required. A managed account is not a listed product. It is a product in its own right. That is the legal and compliance structure on a platform. It may hold listed products underneath it, but double check with your licensee. We might leave it there. There are dozens and dozens of other questions that have come through, but we promise that we will follow up with you all individually. In closing, I just wanted to thank everybody for joining. Please complete we'd really value if you're able to complete the questionnaire and feedback that follows this webinar. You will all receive a copy of this recording and the slides. If you have any questions, please, as I said, email info@betashares.com.au, or please reach out to your account manager. In any event, we will follow up with you. Your account manager will follow up with you and request a very short Zoom meeting just to see if there is any applicability for the Betashares Managed Accounts and the Business Acceleration Services. So we'll look forward to catching up with you then. Again, thank you all for joining us today.